Fair. So let's resume back. Now there are two concepts over here. One is a forward rate concept and one is the bond risk concept. First we look at the forward rate. Now forward rate as a concept is used extensively in the chapter on interest rate management. The last chapter that you will do is interest rate management, where forward rate as a concept is used. Now what do you mean by the words forward rate? These are rates which are expected to prevail in the future years. That is what is called as a forward rate. So when you look at the forward rate, for example, over here, if I take an example as given in your concept book, if the interest rate for 1 year borrowing is 10%, okay, and the interest rate charged for this by the same bank for a 2 year borrowing is 12%, then if a 1 year borrowing is charging 10%, when I go to a 2 year borrowing, they are charging you 12%. 12% is per annum, which means in the first year also you will pay 12. In the second year also you will pay 12. No sir, but actually in the first year, if I go to take a first year borrowing, it would be only 10%. But if you take a 2 year borrowing, on an average, they are going to charge 12% from year 1 and 12% from year 2 as well. So what is implied, hidden in this rate is what is the rate that bank expects in the second year. Remember, 12% is average rate for both the years. What is the rate that bank expects in the second year is what we need to find out. These are called as forward rates. Did you understand the meaning? So what is a forward rate? Well, a 1 year deposit is giving me 10%, a 2 year deposit is giving me 12%. It is not just 12% for the second year, it is 12% for both year 1 as well as year 2. So if in year 1 everyone was happy at a 10% rate, then why is there a 12% in year 1 and 12% in year 2? Because probably the rate in the second year would have been different. So how do you find the forward rates? There is a principle of arbitrage whereby you will say that, well, if I start at 1 rupee now and whether I borrow it at 12% for 2 years or if I borrow it at 10% for the first year and then at whatever is the prevailing rate for the second year. Ideally, my 1 rupee is going 2 years later. So if 1 rupee, let's say it is a borrowing or let us say it is a deposit, if I start with 1 rupee and if I borrow a deposit at 1 rupee for a period of 2 years, then what is the rate of interest? Well, this is 12% per annum. So this is 1 plus 0.12 raised to 2. This has to equal that same 1 rupee going in the same bank after 2 years, that is 1 plus 0.1 for the first year plus let us say 1 plus R2, that is the rate of the second year. I don't know what the rate of the second year is. So therefore, if I do this working, this is probably 1.2544 equals 1.10 into 1 plus R2. Therefore, you will have 1.2544 divided by 1.1 comes to let us say 1.1404 equals 1 plus R2. Equals 1 plus R2. Therefore, R2 over here will equal 0.1404, that is 14.04%. What does this mean? This means that the rate prevailing in the second year, is let us say 14.04%. Now, what does this indicate? This is a forward rate. A student gets confused between a forward rate and a yield to maturity. What does it mean? Let us say if you look at your CA final papers, let us say in your CA final, in your FR, AFM, let's say audit, let us say a situation where you also had to write law. Thankfully, it now goes in the SPOM, but let us say your marks are 60, 60, 40 and 40. For a simple averaging, we are taking 4 subjects. Which means your total marks are let us say 200, and if I were to ask you average marks per subject, this is 200 divided by 4, we can say 50 marks per subject. So we can say on an average your marks are 50 marks per subject. This is like your YTM. YTM is average. If there are 4 years, we are saying if hypothetically in each of the 4 years it will be 50, 50, 50, or each of the 4 subjects it is 50, 50, 50. Forward rate on the other hand says, well, there are 4 years, that is 4 subjects, each subject how much is a mark? Achha, in the first year how much is a mark? Okay, in the first year you have 10%, in the second year you have 14.04%. Are we understanding this? So forward rates can be used to even find the yield to maturity. We can say that okay, 1 plus 0.1 into 1 plus, let us say, 0.1404 will give you what 1 rupee fetches after 2 years. In fact, instead of doing this deposit for 1 year and then again another deposit for 1 year, you can also run that same deposit in the same bank for 2 years. That would have given me what amount? So this is the equation you can use probably to find the forward rates. And forward rates are used a little bit extensively when you do the interest rate chapter. In your valuation chapter, there are just a couple of problems which are there, of which one of the past exam questions we will try, so that you are used to this forward rate concept. From an exam perspective, YTM is more important, forward rate is relatively less important. Okay, are we clear with this? Okay, so let us try a question pertaining to forward rates. Let us go to question number 5. It's a January 21 main exam question. Just a second. Let me review this. Over here, you go to page 6, question number 5. Okay. Following are the yields, that is returns, on a zero coupon bond having a face value of 1000 rupees. So there is a zero coupon bond having a face value of 1000 rupees. These are the yields given. Okay. So the maturity, just a second. So the maturity in years is 1, 2 and 3, and you have been given 3 different yields to maturity very clearly. This is not a forward rate, this is yield to maturity. Assume that the term structure of interest rate remains the same. That is what you expect actually happens. You are required to calculate the implied 1 year forward rates. And then sub point 2 we will see what is to be done. First you are required to find the implied 1 year forward rate. So in year 1 we can say R1, the rate in the first year is the rate of a zero coupon bond, that is equal to 10% per annum. However, when you look at the second year, this is a yield to maturity. What do you guys think? Think and tell me. Option 1, 11% is what? Is 11% option 1 the average rate for both years, 11 in the first year, 11 in the second year? Or is it the forward rate, that is only the rate of the second year, option 2? What do you guys think? Is it the average rate? That is right, it is the average rate. Whereas forward rate, because the question very clearly tells you yield to maturity. Yield to maturity means on an average, if I were to buy the bond today and hold it for 2 years, on an average, what is the average return I am earning in each of the 2 years? That is the yield to maturity, literal definition. So over here, if I want to find the forward rate, how will I do that? Well, in question number, I think question 4, 5, whatever it is, in this question, you will say that if I had 1 rupee, which I invested for 2 years, that would fetch me 11% on an average for 2 years. So this 1 rupee after 2 years will become 1 plus 0.11 raised to 2. Alternatively, I could have made this investment in the first year and got 10% return. And then whatever money I have, I invested it in the second year for the return that the second year would give me. Now ideally 1 rupee is invested for 2 years in same type of products, you should give the same final answer. And hence this will be what? 1.11 into equal to, so this is 1.23 to 1 equals 1.1 into 1 plus R2. Therefore 1.23 to 1 divided by 1.1 equals 1.12. Approximately that is equal to 1 plus R2. I mean that is around 1.1201. So therefore R2 can equal 12.01%. Now what I want you to do is, I want you to pause and try for the third year. You have found R2 to be equal to 12.01% for the third year. Even earlier while discussing, I had given you example of 2 years only. So I want you to pause and try for the third year. Okay. So over here, if you have tried, there are 2 ways in which you can solve. Both of this will give you the same ultimate answer. We will say that for a 3-year maturity, this is 12%. So this is 1 plus 0.12 raised to 3 equals, so you can say that 12% for a period of 3 years would be either equal to 1 plus 0.12 raised to 2. You can either do that 1.11 raised to 2 into 1 plus R3, or you can say that this 1 plus 0.11 raised to 2 is nothing but 1 plus 0.1 into 1 plus 0.1201. Thereby, if you do this working, this is 1.12 raised to 2 raised to 3, this is 1.4049, 1.12, 1.4049 equals 1.2321 into 1 plus R3. Therefore, divide by 1.2321 will equal 14.03. Ultimately, all said and done, ultimately R3 will come to 14.03% per annum. Now, what does this 14.03% actually indicate? This 14.03% actually indicates the rate which is prevailing in the third year. So this is R3, rate which is prevailing in the third year, 14.03%. Now, what does the question ask in subpoint 2? So subpoint 1 is done. Subpoint 2 says you are required to find the expected yield to maturity and prices of 1 year and 2-year bonds at the end of the first year. Now you are already having the data, yield to maturity and everything. You are already having, these are zero coupon bonds with a face value of 1000. You are already having this data today. But the question says at the end of the first year. Now at the end of the first year, the question says that the term structure remains the same, which means what you expected over the term actually happens, which means now you reach at the end of the first year. Now you guys think and tell me, at the end of the first year, will the first year bond have matured? Yes. But for the second year bond, out of the 2 years, 1 year has gone by and hence only 1 year is remaining. So if I look at the second year bond, let us say this was bond 2. So for the second bond, 1 year is still remaining. Which is that 1 year? It is the second year. 1 year is already over, 1 year is remaining, it is the second year. Now if I were to go in the market at the end of 1 year, and try to make an investment for 1 more year. Let us say I take dates. Let us say today I was sitting earlier on 1st of April 2024. I expected R1, that is in the year 24-25, I expected the rate to be 10%. R2, that is for the year 25-26, I expected the rate to be 12.01%. And R3, for the year 26-27, I expected the rate to be around 14.03%. Now, I move further 1 year. Now, the revised date that I am standing today is on 1st April 25, 1 year later. This is plus 1 year. This is 1 year later. Therefore, the rate for 25-26, can you guys tell me what will be the rate for 25-26? If the term structure is to remain the same, that is you expected a 12.01% rate in the year 25-26. Actually, when you reach that point, you actually see that the rate is 12.01% only. So over here, if today you are now on 1st April 24, the rate for the year 25-26, the bond now has, the original 2-year bond now has only 1 more year remaining, and hence for the year 25-26, what will be the rate? Can you guys tell me? 12.01%. That is right. The rate over here will be 12.01%. And for this bond, what do you guys think? How many years are remaining? 1 year is remaining. So over here, if 1 year is remaining, therefore we can say the present value will be 1000 rupees into the PV factor at the rate of 12.01% for the first year. So this is 1 divided by 1.01 comes to 0.8928. This is 892 point, let us say 7 or 892.8. Are we clear with this? Okay. Now comes the difficult part. Let us say the third bond. The third bond actually had 3 years, out of which 1 year has gone by. So how many years are remaining? So if I look at the third bond, for the third bond, how many years are remaining? 1 year has already gone by, and hence 2 years are actually remaining. Now today you are sitting, let us say, on 1st of April 25. These 2 years that are remaining are the year 25-26 and the year 26-27. Now in the year 25-26, you expected the rate to be around 12.01%, and in the next year you expected the rate to be around 14.03%. Now what will be the YTM? Well, we don't know what the YTM is, but we know that 1 plus, let's say, x squared will equal 1 plus 0.1201 into 1 plus 0.1403. Therefore, you will say 1 plus x squared. X is like the YTM, 1 plus x squared equals 1.1201 into 1.1403. This comes to 1.2773. Therefore, if I take the square root, 1 plus x equals, if I take the square root, this is 1.1302. That is, x equals 13.02% per annum. This is an average. Ideally, for this bond, 2 years are remaining. In the coming year, I expect a 12% return. The year later, around 14% return, which means on an average in each of the years. So in 1 year 12, 1 year 14. So on an average in each of these years, I'm expecting a 13.02 return. Are we clear with this? The question is asking for the bonds at the end of year 1. They are not asking you specifically for the bonds. They are asking you expected yield to maturity of a 1 year and a 2 year zero coupon bond at the end of the first year. At the end of the first year, the first bond is not there only, so there's no question of yield or price. The other two bonds still remain. So this bond, the first bond, has matured at the end of the first year. So the remaining bonds are these two bonds only, and hence whatever is asked is for these two bonds only. So over here we will say that the workings would be 13.02, and the value, if you want to find, is the present value of future cash flows. 0 rupees received in the first year, 1000 in the second year, into the present value factor at the rate of 13.02% for the second year, and hence 1 divided by 1.1302, 1 and 2, 0.7829, and hence 782.9 is the value. Are we clear with this? Yes? Okay, so this takes care of the forward rate question, and arguably the most complex question on forward rate, which was asked in the January 21 paper. November 20 and Jan 21 were two quite complex papers of AFM. There are other papers as well where there were medium level complexity. In these two papers there were fairly more complex adjustments. So this was one of the January 21. After COVID, Institute kind of came out with deadly AFM papers back to back. Okay, so that is pertaining to forward rates. Now you go to bond risk. Okay, now till now what you have tried to focus is on how to find the value of the bond. You focused on how to calculate the returns for a bond, but how do you find the risk of a bond? Like, if you kind of take perspective with a share, in case of a share, we try to find how much return will Reliance share give me. We say Reliance will give me dividend, Reliance will give me capital appreciation. That is called as return measurement for Reliance. That is how you measure return. However, I want to find the risk of Reliance. How will I measure the risk? There are various methods that you will study. Let's say in portfolio, something like beta, something like standard deviation. These will measure the risk of Reliance. That what is beta? Beta refers to the responsiveness of Reliance to the movement in the underlying market. If you are aware about beta, standard deviation also we'll study probably when we do portfolio. But when we look at bond, what will you look at as the base? Now bond has three features. One is the coupon, one is the maturity, and one is, let us say, the market rate of interest that is required. That is the required rate of return, also called as the discount factor. Now what do you guys think? Will the coupon keep on changing or does the coupon remain the same? Well, coupon usually remains the same. Does the maturity keep on changing or generally the maturity stated remains the same? Yes, it does remain the same. However, does the market rate of interest keep on changing even after the bond is issued? Can RBI keep on changing the market rate of interest? Well, yes. And my question is, if the market rate of interest changes, will the bonds price also change? At the beginning, remember we said that yes, if the market rates of interest changes, if RBI reduces the rate or if RBI increases the rate, if the market rate of interest changes, the bonds price will also change. Like in equity shares, see, bond you don't do as much. This is only one small section where you do bonds. Equity you do a lot. So if you compare it with equity, we say why should your equity share move? We say if the Nifty moves, my equity share will also move. But if the Nifty moves by 10% and my beta is, let us say, 2 times, I will move double that of Nifty. Are barabar ke nahi? In a similar way, if the market rate of interest changes, the bond price will change. You think and tell me, okay? Answer in the chat box. What is the relationship? Is it an inverse relationship or is it a direct relationship? That is, market rate of interest increases, what will happen to the bond price? It will fall. That is right, it is an inverse relationship. Further, if the market rate of interest falls, what will happen to the bond price? It will increase. There is an inverse relationship. But what we just know is the nature of relationship, that is inverse. We don't know the strength, the magnitude. Like beta shows the strength. If beta is 2 times, 2.5 times, 3 times, it shows that your movement is 2 times that of Nifty movement. Whereas if beta is only 0.5, your movement is only half that of Nifty movement. In a similar way, for bond, how do you measure the risk? Bond risk is measured using a concept called as Machiavelli's duration. Now, this is very important even from a practical standpoint as well as when we see such sums in the exam. There's a concept called as Machiavelli's duration. What do you mean by Machiavelli's duration? Machiavelli said that I need a number which takes into consideration all the factors of a bond. So, if I go back to my same original bond, which was, let us say, a 4-year bond with a coupon of 7 rupees in each of the year, and at the end 107 at the end of the 4th year. This is my cash flows. Discount factor on this bond was, let us say, at the rate of 10%, which was 0.9091, 0.8264, 0.7513 and 0.6830. So if I were to find the present values, this was 7 into 0.9091 m plus, this was around 6.36, 7 into 0.8264, this was 5.78, 7 into 0.7513 comes to around 5.26, and 107 into 0.6830 comes to 73.08, and hence the total over here would be around, if we go to see, 80, so 6.36 plus 5.78 plus 5.26 plus 73.08 comes to around 90.48 approximately, little bit of approximation here or there. Now this was bond evaluation. Now what does Machiavelli say? Machiavelli says that the years that the bond takes is important. Longer the maturity, can I say higher is the risk? Why? Because if it's a 20-year bond, which was only going to give me a coupon of 7% and RBI increases the rate of interest to 10, 11, 12, 15, I'm stuck with this bond. I'm stuck with this bond for a much longer period. Whereas if I look at, let us say, a bond which is only for a 2-year period, if it's a 20-year bond, I'm stuck with this lower coupon for 20 years. Whereas if it's just a 2-year bond, okay, I'm just stuck with it for 2 years. After that, I'll get my money back and I'll reinvest in a bond which gives me a higher return. So the longer the maturity, longer is the risk. So Machiavelli says, yes, you have to look at the maturity. But Machiavelli also says you have to look at coupon. So let us say this is a bond which is giving me 777 rupees in each year. Possibly there can also be a 0 coupon bond. A 0 coupon bond gives me nothing in year 1, 2 and 3. If something happens suddenly, all my money is lost in the 3rd year. At least a coupon bearing bond gives me some money that I am recovering each of the years. A 0 coupon bond gives me nothing. And hence, higher the coupon, lower is the risk. Why? Because the more coupon I receive earlier, at least I'm recovering some of my investment. If you understand payback period, that you must have studied in your CA intercapital budgeting, payback period says that the earlier I recover my investment, lesser is the risk. The later I recover my investment, more is the risk. So Machiavelli says I also have to look at the coupon, because even if it's a, let's say, 4-year bond, if that bond is giving me heavy coupons in year 1 and 2, at least I'm recovering a lot of my investment in the earlier years, and hence it is inherently less risky as compared to a bond which is giving me almost all the money at the end. So Machiavelli says I need to look at the coupon, I need to look at the tenure. In any case, the market rate of interest can keep on changing. I need to look at all of these. So what is that number which considers all of this? They calculate a number called as duration, which is a time based weighted average. It says summation of T into PVCI at each of the point upon summation PV of all CI. So it is a time based weighted average. So it says T, that is the years, into PVCI. So this is T into PVCI. If I do, this is 1 into 6.36, that is 6.36, then 2 into 5.78, 11.56, 3 into 5.26, 15.78, and 4 into 73.08, 292.32. If I total all of this, can I say what I've done is summation of T into PV of CI? All of this, summation T into PV of CI comes to approximately 326.02. So in the numerator, I will say 326.02 divided by summation PV of all CI. Can I say this is 90.48, that is summation PV of all CI. This is nothing but a weighted average, where let us say you are taking time as a base and the cash flows received at each time as weights. 90.48. So if I divide this by 90.48, I will land up with 3.6. Now what does this 3.6 represent? This is 3.6 years. This is called as Machiavelli's duration. Now institute will not ask you the logic. We will try to understand the logic though. What does this number 3.6 indicate? There are two interpretations of this. There is something called as a payback period. What do you mean by payback period? By what discounted payback period? By what time will I recover my investment? That is approximately 3.6 years. Remember, the earlier I recover, the better it is. The later I recover, the riskier. So when I look at the payback period, the shorter the payback period, lesser the risk. Longer the payback period, more the risk. Alternatively, there might be a concept that you might have studied and forgotten as well, of average due date. Have you heard this concept before, average due date? What does average due date actually mean? Average due date means that if I have sold goods to a customer and I've sold goods at multiple dates and payments are going to come at different dates. Now rather than that customer making different payments at different dates, if that customer were to make a single payment on a single date, which date would that be? I'll again repeat, average due date means that if I keep on selling goods to a customer for which money is to be recovered at different dates. Now rather than customer paying me money at different dates, if I were to tell the customer that you have to pay me lump sum, all the money at a single date, which date would that be? That date would be 3.6 years away from today's date. That is Machiavelli's duration. So over here, the higher the coupon, so if this was not 7, if this was higher number, maybe my average, my answer would have been lesser than 3.6. Or if this would have been a 0 coupon bond and everything was received at the end, then my answer would be very close to, or almost 4 years. So what I'm trying to say is, I'm trying to look at the coupon, I'm trying to look at the discount factor, I'm trying to look at the number of years, and also the cash flow that is received in each of the years. Merely because it is 4 years I take 4, no, it is possible that this bond was not an, this is a bullet bond. This is a bullet bond, but it is very much possible this bond was an amortizing bond. That is, in year 1, 2, 3, 4, you are paying coupons, yes, of 7, but principal is also getting repaid. How much is the principal repayment? Let's say 25 rupees each year. 25, 25 and 25 ultimately paid. So in the next year, 75 into 7%, 5.25. In the next year, around 3.5, 1.75, and this is how you will have your total cash inflow. Your cash flow will be 32. This will be 30.25. This will be 28.5. And this will be 26.75. you will discount this at the discount factor at the rate of 10%, find the PVCI. Now if you go to see, it is not that all cash flows are almost going to be received in the last year. Cash flows are received in each of the years. So if I do this working, let us say 32 into 0.9091 comes to around 29.09, 30.25 into 0.8264 comes to around 24.99 or 25 approximately, 28.5 into 0.7513 comes to 21.41, and 26.75 into 0.683 comes to around 18.27. Probably the total comes to around 93.77. And if I do T into PVCI, my T into PVCI will be 1 into 29, approximately 29.09, 2 into 25, approximately 50, 3 into 21.41, approximately 64, and 4 into 18.27, approximately 73. So this is around 216. So if I look at 216.4, now if I do the duration, this will be 216.4 divided by 93.77. So my duration will come to around 2.3, which is lower as compared to earlier that I calculated 3.6. Why? Because, well, the bond is still having 4 years, but a lot of the cash flows are recovered earlier as compared to later, and as a result the bond has lesser risk as compared to a similar 4-year bond where the principal amount was entirely going to come in the last year. Are you understanding this? So when I'm trying to look at, let us say, the duration, in the duration, simplistically, mathematically your answers will come. A lot of times students are unable to understand what this number means. What does 3.6 means? What does 2.3 mean? It means that from today, if instead of paying 4 different cash flows, if theoretically you had to pay a single cash flow at a single date, which date would that be? Well, in the second bond, that will be 2.3 years away. In the first bond, it will be 3.6 years away. If you apply the concept of payback period as well, the longer the payback period, higher the risk. The shorter the payback period, lower is the risk. Which of the two bonds do you think is more risky? The first bond or the second bond? The first bond is more risky because it carries a higher duration. Higher the duration, higher is like the payback period. Higher the payback period, higher is the risk. Are we clear with this? Sir, why is duration considered to be a universally accepted measure of risk for bonds? Because it considers all the 3 features of the bond. It considers the maturity, it considers the coupon while calculating it, it also considers the discount rate. So when I calculate T into PVCI, T will consider the maturity, PV will consider the discount factor, CI will consider the coupons. It considers all the 3 essential ingredients inside a bond, and hence all else remaining constant, it gives you a good perspective into bond risk. So this is Macauley's duration. Now Macauley's duration is used in order to find the volatility. Like beta was used to find how much will be the responsiveness of your stock vis-a-vis the movement of the overall market. We use Macauley's duration to find something called as volatility. Now volatility, another word for volatility, is also called as modified duration. What do you mean by modified duration? How do you calculate modified duration? This is calculated as Macauley's duration upon 1 plus the existing yield to maturity. The derivation over here is fairly complex, but from an overall understanding as of now, this is more like a regression type of an empirical working. But what you need to understand is, you try to find a model which looks at the duration, and the only thing that can possibly change in the bond, does the coupon usually change? No. Does the maturity usually change? No. But does the market rate of interest change? Yes. The discount factor, it can be called as market rate of interest, the discount factor, yield to maturity, whatever it is, that is what is changing. So in one formula you bring both of them together. So you look at Macauley's duration is 3.6 divided by 1 plus YTM, that is 10%. This 10% will possibly change. Like in regression, if you remember, like elasticity and all of this, what do? You say that if this interest rate changes, bond price will also change. By how much will it change is what we are trying to say. Currently the interest rate is 10% and the duration is 3.6, and considering that, the volatility will be found as let us say 3.27. Here you don't go into years, you don't say that this is a percentage, forget about the units. Like in beta, you don't look at the units, you say beta is 2 times, that's it. In a similar way, this is 3.27 times. Technically it is years, however now we are using this volatility in order to find how much will the bond price change. This is fairly complex. However, if you do sums, I'm pretty sure you will be getting a hang of this. So over here, this is 3.27. So what does it mean? It means that for a particular change in interest rate, delta I, that is a change in interest rate, the bond's price will also change. So if the interest rate changes by 1%, bond price will change by how much? By 3.27. Like if beta is 3.27, it means that if Nifty changes by 1%, your stock will change by 3.27%. But usually your stock and Nifty have a direct relationship. If Nifty increases by 1%, your stock will increase by 3.27%. If Nifty falls by 1%, your stock will fall by 3.27%. That is a direct relationship. But in bonds, the market rate of interest and your bond price, that is present value, have an inverse relationship. So if the interest rate increases by 1%, what do you guys think will happen to the bond price? Will it increase or will it decrease? It will decrease. By how much? 3.27%. So over here, you will say that for a 1% increase in interest rate, the bond price will, let us say, fall by 3.27%. However, you are expecting the interest rate to increase by only 0.5%. Then the bond price will fall by how much? So it is like a cross multiplication, where if you cross multiply, you will say 3.27 into 0.5 upon 1 will come to around 1.62%. This will be the fall. Therefore, the revised bond price would be, well, my existing bond price was around 90.48. So my revised bond price will be 90.48 minus 1.62%, because it is going to fall. 90.48 minus 1.62% comes to around 89.01. This will be your revised price using the duration measure. Alternatively, you can also find the intrinsic value. Remember, if you are expecting the interest rate to go up, you will say the discount factor will change from 10% plus 0.5 will come to 10.5%. So you are saying that your discount factor will be 10.5%. So the bond's value will be 7 rupees into the PVAF, now at 10.5% for a period of 4 years, plus 100 into the present value factor at the rate of 10%, sorry, 10.5%. 10.5% for the 4th year. So if we do this working, you will get approximately the same answer, though not exactly the same, because there might be some slight differences. 1, 0, 5, 1, 2, 3, 4. This is what? 0.6707, and grand total, this is 3.1359. So this will be 7 into 3.1359 m plus 100 into 0.6707 m plus MRC, and this is again 89 point something, 0.02. For all practical purposes, it is exactly the same. Now, a student can say that, sir, a bond manager can always do this calculation and find the value. Why are we finding the duration, Machiavelli duration, modified duration? Why are we doing that? Because practically a bond manager will have 50 bonds in front of him or her, in which case, if he has to take a decision on what he has to do in response to a market a change in the market rate of interest, he will not go and sit and find the intrinsic value of each of this bond. He can just look at the duration number. One is at 3.6, one is at 2.3, one is something else. He can just look at the duration and kind of infer that, okay, this bond will change the most, this bond will change the least, and hence he will be able to make his decisions faster. Are you understanding? Understanding the significance of quantifying? Because see, ultimately the answers are coming for all practical purposes to be almost the same. 89.01 and 89.02 for all practical purposes is the same. So one can sit and calculate 89.02 by taking the present value of the revised cash flows at 10.5%. But rather than doing that, if I just have that number 3.27 in front of me, I can say that, well, in response to a change in the interest, this bond is going to vary by 3.27, someone else is going to vary by some other proportion, and accordingly I can make much more efficient decisions for a big series of bonds where I can decide which bond to buy and which bond to sell, and hence duration serves as a decision basis for a bond manager. If you decide to make your career in fixed income or bonds, duration is the thing that you will track. Like for equity, beta is the thing that you track. Is everyone clear with the mechanics of duration as well? See, you will be able to calculate it. I'm pretty sure right now this might sound to be very daunting because unfortunately in CFA this is a separate subject, fixed income. In your AFM, forget being a separate subject, it does not even have a dedicated chapter. So what they've tried to do is they've done everything which is there in one subject into one part of one chapter. So today, I mean, when you do bonds, even now or later, it might sound to be a little challenging because you have not done much of bonds at CA Inter. At CA Final also, you have directly been introduced directly to the advanced concepts of the bonds. But well, that is the case. Institute has asked you about Machiavelli's duration and modified duration and a lot of these things. So we should be aware of this. Once you go to the equity sections, things become usually a lot more manageable. But bond can come in the exam, and if it does come, you'll have a small question on that. If you know these basic principles properly, you can score really well in case of a bond question. So let us go to question number 6. It is a question where we kind of practice what we have learned. Over here, it's more of a practice question. You can pause, practice and try on your own as well. So following is the data available for a bond. The face value is 1000, coupon rate is 16%, which means the coupon amount is 160. Years to maturity is 6, redemption value is 1000, yield to maturity is 17%. You guys tell me. Coupon rate is 16%, yield to maturity is 17%. The final answer of the bond value, intrinsic value, will be higher or lower than 1000? Lower. That is right. What is the current market price? Acha, remember the question is asking you market price. You will find intrinsic value as the present value of future cash flows. Now, if nothing is given, the market is efficient, whatever is the intrinsic value will be the same as the market price. So, like when you do CA Inter, when you do Gordon's formula, that is P0 equals to D1 by KE minus G, that will give you the value of the share. That is the intrinsic value of the share. If nothing is available in the market, that must also be the prevailing market price. So over here, when you look at the current market price and if nothing else is available, this is also calculated as the present value of future cash flows. Second, you are asked to calculate the duration. Third, you are asked to calculate the volatility. Volatility is that adjustment, Machiavelli's duration upon 1 plus the existing YTM. Calculate the expected market price if the increase in required yield is by 75 basis points. Remember, 100 basis points equals 1%. Therefore, 75 basis points will be how much? 75 basis points will be 0.75 of a percent. So over here, how will you do this working? Well, we will first try to find the value of a bond. Usually we can use PVAF over here quite easily. However, in this case, we have to calculate the duration, which means you have to make the table. Then rather than doing a separate PVAF step, we will prepare the table only. So if you look at question number, what is this? Question number 6, we will have over here years 1, 2, 3, 4, 5, 6. Cash inflow would be 1000 into 16%, that is 160 in each of these years, and then at the end the bond redemption is happening and 1160. Discount factor is at the rate of 17%, and you will somehow try to find the present values. So this is 1 divided by 1.17. This is, you will get this 0.857. So basically, I hope you are clear. This is your regular calculation. You would have done this multiple times. So over here, we will just look at the table over here. These are the discount factors at 17%. You will find the present value, and this comes to 964.07. So this is just a calculative process, comes to 964.07. This is actually intrinsic value. However, if nothing is available, this intrinsic value will also be called as the market price. So this will be the market price. Okay. Now, you want to calculate duration. Now, what additionally do you need to do? Well, we need to prepare a column of T into PVCI. So you will multiply T, that is a year, into the PVCI number, T into PVCI, and you keep on totaling it. So over here, if I look at the data over here, let us say the T is 1 and PVCI is 136. So if I take on your calculators, practice this with me please, 136.75 M plus, then you have 2 into 116.88 M plus, 3 into 99.9 M plus, 4 into 85.39 M plus, 5 into 72.98 M plus, 6 into 452.17 M plus, and MRC. So if I take the total, this comes to around 4089.69. So we will say that okay, Macaulay duration will be 4089.69 divided by 964.07. This comes to around 4.24. Usually this is denominated in years. This is called as the duration. 4.24. What does this number indicate? This number indicates that instead of paying this 160 over a period of 6 years and then paying 1000 at the end of the 6th year, if a single payment was to be made on a single date, that would be 4.24 years away from today. That is called as a Macaulay duration. Again, higher the duration, higher is the risk, because it's like a payback period. So the later you get the money back, higher is the risk. The earlier you get your money back, lesser is the risk. So over here, this is your Macaulay duration. Now if you want to find the volatility, what will I do? 4.24, forget it is years or anything, divided by 1 plus YTM. What will I take? My existing YTM. What is my existing YTM? 17%. So this is 4.24 divided by 1.17 comes to around 3.62, because the change will happen only because the YTM will change. Your maturity, coupon, etc. usually remain the same. We are trying to find out how much will a bond's price change today for a given change in the yield, and the current yield is around 17%, and hence we will take 3.62 approximately. Forget the units. Students over here are always asking a doubt that what should be the units. If you want, you can write years. That's okay. That can be the units. Strictly speaking, mathematically, the units over here will be in years. However, like beta, you don't take the units separately. You kind of look at the magnitude. What does it indicate? Acha, delta I for a change in interest, for a 1% change in interest, the change in price would be 3.62. Over here, we will write percentage. But this is an inverse relationship. So we are expecting the yield to go up, increase by 75 basis points. So over here we are saying for a 1% increase, the bond price will go down by 3.62. It is an inverse relationship. So for a 0.75% increase, the bond price will change and become how much? So if I cross multiply 3.62, this will come to probably 2.715% negative. Therefore the expected price would be, well, your existing price was 964. Remember, if the market rate of interest increases, the bond price has to fall, but it will fall by how much? Well, 2.715% of 964.07, and hence this will be 964.07 minus 2.715% comes to around 937.90. This will be your expected price in response to an expectation of a 0.75% increase in yield. Are we clear with this? What is the question asking you? Well, the question asks you, calculate the expected market price if increase in required yield is by 75 basis points. Okay, so we have found the expected price. I'll take you through another question where institute kind of tricks you a little. Just a second, you don't have to solve that right now. But if you see this question, what does the institute say? If I can find this. I can't really find it. So let us say the question had told you to find the expected market price using the intrinsic value method. Here, this is the expected market price that you have calculated. Institute asked you in one exam question, find the expected market price using duration. Can we say this is an expected market price that you found using duration? But had the question asked you to find the expected market price using intrinsic value method, then will I still use the above, will I still use the above formula and find it, or how will I find it? If you are asked to find the expected market price using intrinsic, that is right, you will find it using the present value factor method. That is, you will say that there will be 160 into PVAF. Tell me what will be my revised PVAF for a period of 6 years, plus 1000 into the present value factor. Again, what is my revised PVAF? Tell me the number please. What is the discount factor that I should take? Will I still take 17%? Now I'm expecting the yield to increase by 0.75%, and hence this will be 17.75%. So using the expected value method, I will say that yes, whatever be the duration be it, if I had to calculate using duration, I would say that okay, 3.62 was my volatility for a 1% change. I'm not changing 1%, I'm changing 0.75, so ideally 2.715% should be my change, and hence the price should be how much? That is expected price using duration, however, or volatility. However, if you were asked to find expected, and you have been asked in the exam, expected value using the intrinsic value method, in which case you would say forget the duration. Intrinsic value is the present value of future cash flows. Now all else remaining constant, if the interest rate increases from 17 to 17.75%, then what will be the impact? So over here, let us say this is 1 divided by 1.1775, 1, 2, 3, 4, 5, 6. This is 0.3752 and this is 3.5201. So if I multiply this 160 into 3.5201 and 1000 into 0.3752, I will get a total of around 938.42, which is approximately equal. There is hardly a 60 or a 70 paisa difference in the valuation. So this is the expected price using the intrinsic value method. Are we clear with this? Yes, okay. So this is your question number 6. Now once you understand 6, this can help you in formulating what is called as a bond strategy. What do you mean by bond strategy? Let us say you have a series of bonds in front of you. Okay, let's say you have around 3 or 4 bonds in front of you. Let's say this is bond A, B, C, D, and you are, let us say you put yourself in the shoes of a fund manager. So you are a fund manager. There is various data given regarding this bond. Let's say this is a bond at a particular price. Every bond is at a particular price. Now, let us say these are 4 bonds and you have been given various maturities, their prices and their coupon amounts. I want to understand from you, let us say this is a bond at 950, this is at 900, this is at 975, this is 1025, this has a maturity of 10 years, this has a maturity of 7 years, this has a maturity of 5 years, and this has a maturity of 2 years. Maybe let us say, I'm taking hypothetical numbers, so don't try to cross compare data over here. So let us say this is having a 2% coupon, 5% coupon, this is having a 10% coupon, and this is having a 7% coupon. And then there is a duration that you have calculated. Macaulay duration, modified duration, whatever it is. Let us say this duration is around 1.7, this duration is around 4.1, this duration is around, let us say, let's say just a second. Okay, the numbers, forget, I mean, it's maybe not be consistent. This duration is, let us say, around 5.5, this duration is around, or let's say this duration is around 6.5, this is around 5.2. For whatever reasons, this came to 5.2. Now, the prevailing market rate is, let us say, 10%, our favorite rate. And now, when will you make money as a bond manager? You don't make money when the rates actually change. You make money if you are able to predict that in the coming policy, what will RBI do? Acha, I am expecting RBI to reduce the rates. If RBI will reduce the rates, then what do I do? And I do it before all of this actually happens. So let us say there is an expectation. There is an expectation of market rate of interest falling by 1%. So your economic advisors are telling you that in the upcoming meetings that are likely to come, because inflation etc. is lower, RBI will reduce the rate by 1%. If you were a bond manager, tell me what action should you take? Let us say you have deployed all your money, 25%, 25%, whatever is your money, all your money you have deployed equally in all of these 4 bonds. Ideally, how much, forget it. Which bonds would you prefer buying given this expectation of market rate of interest decreasing? Or will you prefer selling a bond? First, if market rate of interest increases or decreases, what impact will it have on bond price? Will your bond price increase or will your bond price decrease? Everyone, please answer. Inverse relationship. So if the market rate of interest decrease, what will impact on bond price? Increase. If the market rate of interest falls, bond price rises. Acha, market rate of interest is falling by 1%. Do you think bond price will exactly rise by 1% for each of these bonds? No. It will rise differently. Given a choice, you will prefer which bond? The bond which rises the most or the bond which rises the least? Most. Which of these bonds you think is going to rise the most? A, B, C or D? Which is the number that you are looking at? One of these bonds is going to rise the most. Which of these bonds? See, some students are saying C, some students are saying D. No, coupon you don't have to see at all. Remember the decision when we did question number 6. Coupon is one of the factors, maturity is also one of the factors, discount factor is also one of the factors. Which is a number which takes all of them into consideration? Which is a number which takes all of them into consideration? Duration. So yes, there may be a bond which has a higher maturity, there may be a bond which has a higher coupon, there may be a bond which we say all of this is not relevant. For our decision making, none of this is relevant. What is relevant? The duration column. Remember the impact of bond. See, as a student, you are always thinking that yes, I will look at the coupon, I will look at the maturity. Yes, Machiavelli says you don't just look at the maturity, it is an important factor. You also have to look at the coupon. Acha, you look at the coupon. You don't just look at the coupon, you also look at the maturity. Acha, so what do I look at? Well, I look at all the factors. Which is that number which absorbs the impact of all the factors? Sir, the duration number. Duration is different from maturity. Duration is what you calculate at this time-based weighted average and then probably do some adjustment. Remember, cases where there is a higher Machiavelli duration, automatically you will also have a higher modified duration. If you have a lower Machiavelli duration, automatically you will also have a lower modified duration. So what I am trying to say is, all of this data will be given to confuse you, to throw you off track, to kind of make you select a wrong bond. You will say, forget it. I know that because the bond price is, I know that if the market rate of interest is falling, I know bond price will rise. But it will rise by how much? I don't know. The best guess of that rise is given by the duration statistic. And hence, between all of these bonds, which bond has the highest duration? Bond C. You might have answered C, A, B, D, whatever. If you had looked at the duration column and answered, then you have got this correct. Otherwise, you fell in the trap that the institute set. We will say that forget maturity and coupon and everything. Ultimately, for a 1% change in interest rate, bond price will change vis-a-vis whatever is your volatility, the duration. So whichever bond, let's say bond C has the highest duration, we'll say that okay, given a choice, if I had the money, I will try to put the money in bond C because bond C will go up approximately 6.5%. Bond D will also go up, but 5.2%. Bond A will also go up, but just 1.7%. So if I had 100 crores to invest, I will invest that 100 crores in bond C because it gives me possibly the highest appreciation when RBI actually comes out with the announcement and reduces the interest rate. But let us say I don't have money, then I'll have to churn the investment portfolio. What do you mean by churn? I'll have to sell something to buy something. I'll say, well, I don't have the money. I had 100 crores, out of which I've deployed 25 crores everywhere. I know that I need to buy the longer duration bond. I need to buy the longer duration bond in this case. Why? Because this will go up the highest. For example, bond C. But to invest money in bond C, I don't have any money. It is fully deployed. I'll have to sell some bond. Which of the bond do you suggest I should sell? Why bond A? Well, bond A is also going to go up. Well, but bond A is also only going to go up by 1.7%. Bond A will only go up by 1.7%. So if I have 25 crores invested in bond A, that will fetch me 1.7%. If I were to sell that, get those 25 crores and deploy it in bond C, that will possibly give me a 7.5% or a 6.5% return. Are we clear with this? So generally, if you were to think of a strategy, I don't recommend that you by heart or remember this. You can conceptually think about this. But if this is thinking is a problem, you say that we want to sit back and relax. The bond strategy typically is if the market rate of interest is expected, market rate of interest expected, let us say, to fall, or market rate of interest expected to rise. If the market rate of interest expected to fall, bond price will rise. Achha, if bond price rises, which bond should you buy? Tell me, which bond should you buy? The longer duration bonds or the shorter duration bonds? Buy longer duration bonds. If you have the money, put that in longer duration bonds. If you don't have the money, well, you will sell shorter duration bonds to get that money to deploy in the longer duration bonds so that you can maximize your profits. But if the market rate of interest are expected to rise, the bond price will fall. If the bond price falls, where will I put in my money? I'm a bond investor. I have to put in my money. Like if you see, if you are tracking the stock markets early this week, there was some political tensions where Israel went inside Iran and kind of killed a few of the commanders of Hamas. So there was an expectation of a widespread conflict. And Monday morning, you saw that the market prices fell. Sensex fell. Nifty, every global index also fell. So over here, if you are an equity investor, what will you do? You will sell the risky stocks and put money in safer stocks. In a similar way, over here, in case of a bond, when market rate of interest is going to rise, bond price will fall. Which bonds will fall? All bonds will fall. So what will I do? Well, if I'm a bond investor, well, I will try to minimize my losses. Where will I run? Well, what will I do with the longer duration bonds? Can we tell me? Well, longer duration bonds will fall by 6.5%. Shorter duration bonds will fall by only 1.7%. So we will sell the longer duration bonds. And if I have to invest in bonds, I can keep that money idle in cash as well. But if I have to invest in bonds, buy the safer or the shorter duration bonds. Are we clear with this? Yes. Conceptually, this is a little taxing, but conceptually, you can say that if the market rate of interest is going to fall, bond price will rise. You will put money where it rises the most. That is the longer duration bonds. If market rate of interest increases, bond price falls. You will put money where the fall is the least, that is the shorter duration bonds. So you will buy the shorter duration bonds because the fall is the least. Here you will buy the longer duration bonds because the rise is the most. Are we understanding this? Yes. Okay. So over here, if I go to question number 7 and try to see if you have understood bond strategy properly or not. Let us go to question number 7, please. Okay, let us review this. Okay, the investment portfolio of a bank is as follows. So you have a set of bonds, coupon rate is given, purchase rate is given, and then duration is given. The face value of the total investment is 5 crores in each government bond. This is the face value of total investment is 5 crores in each government bond. Calculate the actual investment in the portfolio. Okay, this is very easy. Face value is 5 crores in each bond. The face value is 100 per bond. That is 5 crores divided by 100. There must be 5 lakh bonds each. So you will say 5 lakhs into 105, 5 lakhs, and you will try to find the investment in each of the bonds. 5 lakhs into each of these numbers. So probably you will get 5 into 106.5, that is 532.5 lakhs, 5 into 105, 525, again 525, 5 into 110, this is 550, and last 5 into 101, 505. So in total, if I see, this is 2637.5 lakhs. So I've invested 2637.5 lakhs in total. That is my actual investment. This is very basic, nothing new over it. Now this is where I want your answer, and I want the chat box to be active. What is a suitable action? What is a suitable action to churn out investment portfolio in the following scenario? Churn out means you are removing something and bringing in something else. So you are selling something and buying something. That is called as churning. If the interest rates are expected to be lower by 25 basis points, just focus on this part. Just focus on the extremes. Which is the bond you will buy? Which is the bond you will sell? Interest rates are expected to be lower by 25 basis points. First, you will always ask yourself that if the interest rates are going to fall, what will happen to the bond price? Get that answer and then come to the conclusion. If the bond price is expected to rise, you will buy the bonds which are going to rise the most. If the bond prices are expected to fall, you will buy the bonds which are expected to fall the least. Perfect. Acha, which column are you looking? Are you looking at this 32, 22, 15, 10 and 6 and coming to the conclusion? No, you should be looking at the duration column. Perfect. So all of this data is going to throw you off track. The relevant data for taking your decision is the duration column. You will look at the bond which has the highest. So this is a bond having the longest duration, whereas this is a bond which is having the shortest duration. Okay. So over here, if interest rates are expected to be lower by 25 basis points, we will say that the price is expected to increase. Now, if the price is expected to increase, you will deploy funds in the bonds where the price is expected to increase the highest, and hence you will buy GOI 2032 bonds, GOI 2032 bonds. But question says churn out, which means you will have to buy, but then if you don't have the money, you will have to sell some of the bonds. So you will buy GOI 2032, but so that you can get approximately a 13% return if the interest rates were to fall by 1%. But where will I get the money? Well, I have to sell something. So what will I sell? I will sell GOI 2006 bond because it has the shortest duration. Now, depending on your confidence, if you are confident that no, it is definitely going to, interest rate is going to fall, you can actually sell everything, 2006, 2010, 2015, 2022 and put all your money in 2032 bonds. That will give you the highest return. But again, it depends on how much confidence you have. Institute does not want to look at your exact which bond to buy, which bond to sell. It wants to see whether you are able to make that conclusion correctly or not. That is, are you in a position to determine whether we should buy the longer one or the shorter one? If you are able to do that, then after that you can select that we can buy 2032, for that sell 2006, also sell 2010. That's fine. Buy the longer duration bond, sell the shorter duration bond. What is the logic behind that? Well, for a fall in interest rate, bond price will go up. If bond price goes up, you select the bond which is going to go up the maximum, and hence the 2032 bond. If you have the money, put that in 2032 bond. If you don't have the money, sell the 2006 bond and put that money. Are we clear with this? Achha, after this lecture, we can become bond fund managers Yes, okay. So over here you need some economics to figure out what is likely to happen for interest rates. Thankfully, institute does not go into that, and institute just tells you that what will happen if the interest rates are expected to go so and so. So interest rates are expected to rise by 75 basis points. Acha, now let us do this together. If interest rates are rising by 75 basis points, therefore bond price will happen what? Bond price will fall. If it is falling, I will try to buy those bonds which fall the least, and hence I will buy which bonds? Answer quickly. 2006 GUI bonds. But if I have to buy 2006 GUI bonds, where will I get the money? Well, I will exit those bonds which are going to fall the most. So I will sell the 2032 bonds. Are we clear with this? Sell long, buy short. That is correct. Is everyone clear? Yes? Okay. After the lecture, sit back and practice on this for a better understanding. And this is the first part. This is the second part, bond strategy. Third part, also calculate the revised duration of the investment portfolio in each scenario. Usually the duration is calculated as a weighted average. So you will calculate duration as a weighted average. However, in this particular case, since the amounts invested are almost the same, can we say simple average and weighted average will give you almost the same answer? See, if the amounts invested are different, then simple average, weighted average will give you different answers. But if almost same amount, that's approximately 20% is invested, almost the same amount, that is 20% is invested in each of them, so your simple average and weighted average should ideally give you the same answer only. So over here, what is your original duration? We will say that original duration is approximately 20% invested in each of them. So this is 3.5 plus 6.5 plus 7.5 plus 8.75 plus 13 divided by 5. So if I do this, this is what? I think 10, 17.5, 8.75 and 13 divided by 5, approximately 7.85. This is the average duration, okay, of the entire portfolio. Now what happens in the first scenario is, you are telling that I will buy the GUI 2032 bond and sell the GUI 2006 bond, which means in my revised portfolio 3.5 will not be there because I am selling the 2006 bond. In fact, there will be another 2032 bond which will have a further 13 worth of duration. So simplistically, I will remove the 20% allocation towards a 3.5 duration and add a 20% allocation further towards a bond which has a 13 duration, and hence we will say 6.5 plus 7.5 plus 8.75 plus, let us say, 13 and 13 divided by, let us say, 5 comes to around 9.75. So my duration will increase, and we will do it much more objectively in later sums where we find the portfolio duration using weighted average. But my duration over here will increase. Earlier it was 7.85, now it is 9.75 because this 3.5 bond is no longer there, but instead of that a 13 bond is there, and hence the overall duration increases. Are we clear with this? Yes, okay. Next you go to question number 8. Let us review question number 8, please. A few interesting things over here. It is a little calculative and you can use this as a base for your practice. I'll also give you one more sum where you have to do pen and paper practice, okay. So I think that is question number 10 sub point 1. We will try it before your class tomorrow. Let us see question number 8. Focus on this sub point A. Consider two bonds, one with 5 years to mature and another with 20 years to mature. So you are looking at two bonds. Both bonds have a face value of 1000 and a coupon rate of 8% with annual interest payments, and both are selling at par. What does this sentence mean? What does this tell you? That means the coupon rate for these bonds equals to the required rate of these bonds. What is the discount factor for these bonds now? Also equals 8%. The question will not, we are just reading the question, nothing over here. We are just focusing on both of these bonds are selling at par. So if they are selling at par, the coupon rate is equal to the required rate, that is equal to 8%. Okay. Assume that yields, institute uses the word yield, market rate, discount factor interchangeably. assume that the yields, that is the discount factors or the required rates of both the bonds fall to 6%. Okay, assume that the yields of both the bonds fall to 6%. Think and tell me, if the yields fall by 2%, what will happen to the market price? Will it increase or will it fall? Increase. Perfect. Going in the right direction. Whether the price of the bond will increase or decrease. Okay, we will answer increase. What percentage of this increase or decrease comes from a change in the present value of bond's principal amount, and what percentage of this increase or decrease comes from a change in the present value of bond's interest payment? Now this is a little difficult to comprehend. The question is very easy. We are sure that the bond price is increasing, but how much of this increase is coming due to the bond's principal and how much of it is coming due to interest? We will do the discussion for a 5-year bond. What applies to a 5-year bond also applies to a 20-year bond. You can practice a 20-year bond on your own as well separately. So we will say existing for a 5-year bond, if you were to see at a 8% rate, we can say, how do you find the value of a bond? Present value of future cash flows. So 8% of 1000, that is 80, into the PVAF at the rate of 8% for a period of 5 years, plus 1000 into the present value factor at the rate of 8% for the 5th year. So if I do this, 1 divided by 1.08, 1, 2, 3, 4, 5, this is 0.6806, and grand total 3.9927 approximately. So if I look at 80 into 3.9927 m plus, this is around 319.42 plus 1000 into 0.6806 m plus, this is around 680.6. So let us say if I were to take a single decimal, 319.4, okay. So what we are doing over here is we are trying to do the calculation, simple calculation, where we are trying to find the value of the bond at the existing 8% rate, that is 319 plus 680, that comes to 1000. As expected, the bond is selling at par. Now at 6%, as you guys have rightly told me that the bond's price should increase, this is 80 into PVF, this will be at what rate? 6%. Can you calculate and quickly tell me the annuity factors for a period of 5 years, plus 1000 into the present value factor at the rate of 6% for the 5th year? 4.2124 and 0.7473. Now 80 into 4.2124 comes to 336.99, and this is 747.3. 747.3. If I were to total this, this comes to around 1084.29. Achha, as expected, is the bond price increasing? Yes, it is going from 1000 to 1084. However, the question says how much of this increase, what is asked, what percentage of this increase or decrease comes from changes in present value of bonds principal, and what percentage comes from a changes in present value of bonds interest payment? So we will say that, well, at the end of the day, the price is increasing by 84.29, that is 1000 and 1084. A part of this increase is due to change in the value of interest. A part of this increase is due to a change in the value of principal. Can you find out how much? Well, interest earlier contributed 319, now it is contributing 336. So I will say 336.99 minus 319.4. Can I say this is 336.99 minus 319.4, that is around 17.59. Can I say 17.59 out of the total 84 is contributed by interest? So this is, let us say, 17.59. Principal you can find as the balancing figure, or you can say 747.3 minus 680.6. So if you take the difference, 747.3 minus 680.6 comes to around 66.7. Even if you did not do that, 84.29 and 17.59, you could have found the difference. Now, if I want to find this in percentage terms, we will say 17.59 out of 84.29 comes to around 20.87% is coming due to interest. And if I find the percentage, 66.7 upon 84.29 in percentage, around 79.13% is coming due to principal. Are you able to comprehend what is asked? It is not a very difficult thing, but when you read this, it is a little unusual. You are not usually asked about this, and hence this gets a little tricky. Now what I want you to do is, you can try doing the working for a 20-year bond on your own in a similar way. What will we do? We will try to find, let's say we did this for a 5-year bond at 8%, 5-year bond at 6%. In a similar way, we will try to do this working for a 20-year bond. We will say 20-year bond today is 1000. Eventually, if the rate becomes 6%, it will be how much? You will try to find the value. How much of this is coming due to interest? How much of this is coming due to principal? And then we will try to figure that out. Are we clear with this? So it will give you a decent enough practice. Is everyone clear? Yes, okay. So you can try point A later after the class and review the solution below for understanding. What is point B and C saying? Point B says, consider a bond selling at its par value of 1000 with 6 years to maturity and a 7% coupon rate. Okay, that is with annual interest payment. What is bond's duration? That is it. It is as if you are solving a question number 6 or 7, I think that we did. We are just asked to find the duration. That is it. If the YTM of this bond increases to 10%, how does it affect the bond's duration? Acha, if the YTM changes, all else remaining constant, discount factor changes. If discount factor changes, the present value numbers change, and this will definitely impact the duration. So if I go to see for points B as well as point C, if I look at the cash flows, year 1, 2, 3, 4, 5, 6, the cash inflow over here would be, this is a, I think, 7% coupon bond. Consider a bond selling at par value. Again, the question says, consider bond selling at par value. So in sub point B, if the bond is selling at par value and the coupon rate is 6-7%, what must be the discount rate? Discount factor is also 7%. You will try to find the PVCI and then do a T into PVCI working. Are we clear with this? So over here, ultimately, because the coupon rate is also 10%, 7%, discount rate is also 7%, if I do the working properly, my answer should come down, let us say over here, to 1000. So this is taking the 7% factors and coming to 1000. Now the problem is I want to find the duration. So if I want to find the duration, I will say T into PVCI, 1 into 65, 2 into, let us say 61, and so on. We will get 5099. 5099 divided by 1000, and this will be around 5.1 years. Okay. The second part of the question goes to the same thing. What if the YTM changes from 7%, let us say, to 10%? Now, even if the YTM changes, the coupon and the maturity remain the same. So over here, as you see, from 1 to 6, you still have 70, 70 and 1070, but now the discount factor is 10%. Obviously, if the discount factor changes, the PVCI will undergo a change, and hence you will find, acha, if your interest rate increases by 3%, bonds price will fall. Okay, so as you can see, your answer is less. Earlier it was 1000, now it is 869. And then you do the T into PVCI workings. It is the same calculation actually. There is nothing new over here. You get 4369, and if I divide 4369 by 869, I can see 5.03 years. So what is my question asking you? You can sit and practice this duration. If the YTM of bond increases to 10%, how will it affect the bond's duration? Achha, earlier the duration was 5.1 years. Now the duration is 5.03 years. Why is the duration changing? The duration is actually changing because the yield is changing. So over here, if I go to see, the duration is changing because the yield is changing. If the yield had remained the same, the duration would not have changed. So this is the reason. What this does is, it changes the proportion. Okay, mathematically, the weight of the earlier years was 6.57 and the last year was 7.71. So earlier at a 7% discount rate, the weight of the sixth year was based on 71.29, but now at a 10% discount rate, the weight of the last year is only 69. So the weight is falling of the later years. Mathematically, you don't need to go into the detailing over here. That's fine. You don't really need to go into the detailing. You just need to remember over here that as the interest rate changes, market rate of interest changes, your duration will change. As you can see clearly, from 5.1 it is coming to 5.03. Now why is it changing? Fundamentally because of the higher discount rate, the later years will be worth much less. Remember, if the discount rate is very high, inflation interest rate is very high, the value of money in later years is much lesser. It loses a lot of value. And as a result, the later years have a 69% weight over here, whereas the earlier years have a 7.32 weight over here. In this case, the earlier years have around 6% weight and the later years have a much higher weight. So, from an exam perspective, this is not relevant. It is asked in the question. It is more of a concept depth understanding that why is this changing. Okay, for most of the students to getting 5.1 and 5.03 right, that is more than enough. Why is it changing is beyond the scope, but usually it changes because the discount rate changes, and when the discount rate increases, a higher discount rate means future years will have much lesser present value, and hence the weight will fall. If future years have a lesser present value, the duration will also fall. Do we need to write the weights too? No. If you see the ICAI printed solution, they have not written the weights, they have just written a single line conclusion that the duration of the bonds will reduce. This is because higher weight is given in the earlier years and lower weight is given to the later years. We want to explain that, and hence we have given the weight column, otherwise the weight column is not even there in the institute solution. Are we clear with this? If you understand this well and good, if you don't, just remember this and proceed. It is not really important from an exam perspective. Whatever had to be remembered clearly, I think we have tried to do that. Are we clear with this? Yes, okay. So before tomorrow's class, I want you to try a particular part on your own. Question number 10. In question number 10, only part 1. So that you practice duration on pen and paper on your own. That's it. So question 10, if we read, the following are the data available for 3 bonds, A, B and C. These bonds are used by a bond portfolio manager to fund an outflow scheduled in 6 years. Current yield is 7%. All bonds have a face value of 100 and they will be redeemed at par. Interest is payable annually. Okay. So there are these 3 bonds, maturity of 10 years, 8 years and 5 years, and there are 3 different coupon rates given. Remember, the discount rate is given to you as 9% over here. Point 1 says, is the past exam question, okay, calculate the duration of each bond. That's it. Point 2, 3, 4 we will do together. But can you calculate the duration on your own? Yes, but in today's class you have kind of done it in rough. You have listened to the workings, but unless you do it yourself, you don't get that confidence. So I want you to try only for this, nothing else. Just find the duration. So it is a very long calculation. You need marks, you have to do the calculation. So just try to do that calculation on your own. Nothing new over here. Don't even touch point 2, 3, 4. We will do that because it is based on a separate concept. Just try to find the duration of the bonds, and I think that should kind of suffice. Okay. Perfect. So I think we will stop for the day, and then we can continue. We'll probably do classes till around 1:45 daily. Here we are at a logical conclusion, so we can possibly stop, but we can do classes till around 1:45 daily. Okay. Okay. So have a good day and revise whatever is done in bonds. We will finish bonds tomorrow and move on to equities as well. So if you do it alongside, trust me, you will be able to kind of make full use of these lectures, and you will have very good confidence in your AFM as well. Okay, so ensure that you do at least this part, and if you have, let us say, the full book or institute material you want to practice, if you want to practice it separately, you can. But at least I would require you, at least while viewing the batch, to at least get used to what is done in the class. Okay, perfect. I'll see you tomorrow. Have a good day. Bye bye. Take care.